Investing was and remains one of the best ways to increase our dividends for a long time. People are not only confident that by making certain moves or acquiring a number of shares, they can earn extra income to add to their portfolio. In addition, due to regulations and new security protocols, they are aware that their investment is safe and in capable hands, which will do everything possible to increase those assets and make profitable returns, both for the company entrusted with that capital and for the investors themselves. Yes, many of us are confident that obtaining shares in certain companies can help us on our way to making a fortune. However, due to the current scenario in the world, and specifically in the monetary sector, many professionals seem to have their doubts about certain assets from various companies. Why have some gurus stopped investing in certain sectors and various companies? Why are they pushing and buying very few shares of a specific site? What can we do if, at this moment, we want to invest, but we're wary of the world economy and its probable crisis? While many have asked these questions, they must understand that the answer, even with inflation almost confirmed, will never be to leave money sitting idle for us. We must find a way for that capital to pay us back, and at times like these, even more so, when prices continue to rise and uncertainty reigns almost everywhere. However, we do urge you to be wary of certain sectors and companies. Let's move on to Goldman Sachs' warning about the future of stocks. The warnings from the most experienced and knowledgeable strategists seem to be many years overdue. However, if you consider that, according to their comments, we have not yet seen the worst of the crisis, we have yet to say that we still have some time before the situation reaches the point of no return. Following the dismal performance of US stocks and bonds, in the wake of the Federal Reserve's benchmark rate hike, the New York Stock Exchange, or also known as Wall Street, was forced to open its trading hours in an unflattering and uniform defeatist mood. This convention is even more expert in the current state of the markets, both domestic and international. Along with the European markets, the most famous US brokerage house led for the second day in a row with a smaller but steady percentage gain. Thanks to the financial instruments that have been implemented in recent days, brokers and analysts are looking to recover after several weeks of impressive losses. The problem? It seems that, despite all that is being done, the danger of an unprecedented crisis is still on the table. That's why Cathie Wood, investor and founder of ARK Invest, came out and attacked the Fed for the unnecessary rate hike, and why such action only shows a couple of signs of downward inflation. She points out that it is not enough to overcome the current economic scenario and its fatalistic trend. Despite the stock market rally, strategists and analysts at Societe Generale and Goldman Sachs have expressed their concern, while stressing that the chances of a recession in the country are high. The numbers don't lie, and the probabilities increase with each passing day. That is why these professionals have stated that this situation will only lead to steeper falls in publicly traded stocks. It doesn't matter if the liquidation of several stocks has allowed the attention of several investors to focus on those assets. In the long run, the crisis will end up scarring everyone involved. Why? As SocGen's Manish Kabra, quote, "A typical recession will see the S&P 500 index fall to 3,200 points, down almost 13% from Friday's close before the holidays." Along with all the warnings that Kabra has made, we can find a newspaper article where he comments that the Anglo-Saxon nation is on the verge of an inflationary shock, very similar to the one experienced in the 1970s. Not only could this present a historic plunge of at least 30%, but based on the current level shown in the tables, a stagnation could also form due to high inflation. Overall, the picture that emerges is very similar to other severe crises experienced more than 40 years ago. Unprecedented and unexpected, considering the amount of time that has passed since those problems. One would assume that, with so many years of experience, getting into the red would be almost impossible, wouldn't it? Of course, such a mess has the potential to cause a nearly 1,000-point drop in the chart, which in turn will take the index to levels that can only be matched by the precipitous drop experienced in March 2020. Correct timing when COVID-19 was declared a pandemic globally. Yes, disease, war, and the subsequent rise in commodity prices are steadily sinking the US economy. Despite the efforts being made, we must admit that either in these months or into the next year, we could be in for one of the most marked crises of modernity. With that certainty in mind, it is worth asking, if the stock market is selling stocks so as to not lose cash flow, is it worth buying them, or is it better to wait until the situation is better defined? Quote, "We have yet to see the real bottom of the stock," Cabra said, and with those words, he has unleashed a whole host of speculation, as well as causing panic among Wall Street investors, buyers, and brokers. Along with his words came a report from Morgan Stanley analyst Michael J. Wilson. For those of you who don't know Wilson, he is one of the most widely known experts on the New York Stock Exchange. He has worked in the field for many years, and his work, experience, and achievements speak for themselves. He was one of the professionals who correctly predicted the last sell-off seen in the US market. This is why, when in the report, he spoke in favor of the S&P 500 dropping another 15% to 20% and about 3,000 points, most of those working on Wall Street decided to listen to his words. Not for nothing did he provide that analyst suggestion, so that the market would finally fully reflect the scale of the economic contraction. Quote, "The bear market won't end until a recession hits or the risk of one disappears." Those were the words he uttered, according to a Bloomberg article. But what if there is a recession? What dangers do we see? In that case, the S&P 500 could reach 2,900 points, and the prices of almost all items of value and necessity would spiral out of control. While some analysts have tried not to be fatalistic in their statements, there are others, such as those at Goldman Sachs, who believe that avoiding the problem will only make it bigger. For them, quote, "The risk of recession is increasing," and they have backed up their comments with a report from the team, which was published last Monday, and pray that they see a 30% chance of the nation going into recession in the next year. Yes, the various reports are far from encouraging, and this in turn explains why many investors and pundits have been uncertain about the economic outlook in recent months. The same analysis states that they see a 25% chance of going into recession up to the second year of the first signs of crisis. However, the latter could only be realized if the closest prediction is avoided first, which in turn would mean an increase in the projections that have been given previously. Quote, "We now see the risk of recession as larger and more important," economists led by Jan Hatzius wrote in the note. Quote, "The main reasons are that our baseline growth path is now lower, and that we worry that the Fed will feel compelled to respond with a heavy hand to high headline inflation, even if economic activity slows sharply." And with these final comments, we conclude today's video. Although this time we have shown opinions and figures that are not very encouraging, remember that many millionaires and billionaires continue to advise investing and buying shares, as an alternative that can be compared to other income-oriented activities. Still, before you buy anything, we recommend that you first research the current state of the company, along with its performance in recent years. For now, we ask you, what would you do if you were in the shoes of the Goldman Sachs analysts? Would you try to get the warnings of falling shares out to more people? Or would you prefer people to continue to rely on those lines of business that, at the moment, are being hit hard by issues such as war, pandemic, and the economic crisis itself? Leave your comments on the subject, and don't forget to add your suggestions for future videos. We are reading them. Thank you very much for staying until the end, as well as for your subscription and like. See you next time!